Welcome back. You're watching us here on Halftime Report. Let's talk about a special series, Fin Street, where Abhishek Kothari explains how loan growth is back in the banking sector. Abhishek, what are the key trends?
Well, in Fin Street today, let's focus on the loan growth that has come back in the banking sector. It's the best ever in H1 FY23 on an incremental basis. So, incremental loans in H1 FY23 amounted to rupees 7.4 lakh crore. This compares to negative growth seen in the loans of the banking sector over the last 3 fiscals. So, majority of the loan growth has been driven by retail segment, followed by working capital in the corporate segment. So, capex-based demand is starting to come back, but we are yet to see any meaningful growth so far. Some of the loan growth has also come back for the banks by making inroads into segments which were dominated by the NBFCs. In lieu of the bank loans taken, NBFCs have opted to securitize their portfolio with banks. This has helped some of the banks or the banking sector in incremental loan growth as well. So deposit growth too has been good in H1. Although the fact that growth rate has come down on a year-on-year basis, deposit added in H1 FY23 so far has been about 5.67 lakh crore, up about 17.6% YOY. In fact, the amount of deposit accretion that we have seen in H1 FY23 is the second best in the past 13 years. With deposit momentum slowing down related to the credit momentum, there has been sharp rise in the credit deposit ratio of the banking sector. Credit deposit ratio of the sector was at 74.15% as of September 2022, best since 8th May of 2020 when it was a little more than 74%. Let's now take a look at the business updates which has come in from banks on a more granular perspective. Deposit growth for the sector was around 9.2% YOY and about 2.8% sequentially. Now, strong deposit momentum was seen for the likes of IDFC First Bank, Ujjivan Small Finance Bank and AU Small Finance Bank. All of them saw a deposit growth momentum of more than 6.5% quarter-on-quarter. Weak deposit growth was seen for the likes of Bank of Maharashtra and RBL Bank, who had a relative flattish quarter-on-quarter in terms of the deposit momentum. Loan growth was robust for the sector at 16.4% YOY and around 4% sequentially. So strong loan growth momentum on a sequential basis was seen for the likes of CSB Bank, AU Small Finance Bank, Ujjivan Small Finance Bank, Federal Bank as well as SDFC Bank, all of them who had more than 6% quarter-on-quarter loan growth momentum. Now, CASA or low-cost deposit momentum was a mixed bag for the lenders. So of the 15 lenders who gave the business update, 8 of them saw an improvement in the CASA ratio, while 7 of them saw a decline in the CASA ratio. So credit deposit ratio on the back of strong loan growth has largely improved for many lenders. On an average, the CD ratio has improved anywhere between 100 basis point to 400 basis point. However, the likes of Equita Small Finance Bank, Ujjivan Small Finance Bank and Bandhan Bank have seen a decline in the CD ratio of more than 140 to 150 basis point on a sequential basis. So the sustainability of strong loan growth is a concern given the macro outlook and the impact of inflation. Now, capex demand is yet to come back, although bankers have started hinting at receiving queries on the same. Net interest margin will improve in Q2 FY23, but needs to be seen on the context over the next couple of quarters. So deposit growth is a major concern. However, credit deposit ratio provides cushion over the next few quarters.
Okay, all right, Abhishek. Thanks very much for that. So credit deposit ratio has improved to around 74.15% at this point in time. Take a short break. On the other side, Manisha Gupta will join in. She'll be talking to Surendra Mehta of